Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about Trump's call for lower interest rates and where that puts the Fed, plus a big deflationary move on the rental index. Logan, welcome back to the podcast. We have so much to talk about.
Sarah Wheeler, I demand you to lower mortgage rates and get the global bond market or get global Fed policymakers to do it as well.
Yeah, right. So we are going to be talking about Trump was at the World Economic Forum this morning, or he had his remarks there, and he called for lower interest rates. It actually demanded lower interest rates. So talk to us about why he's doing that. Why does that play into what he wants?
So let's go back to November 7th, 2024. We did this big, long podcast about what is economic policy going to be like under the Trump administration. Like, what does he need? And number one, it's, lower rates and lower dollar. So the lower dollar thing, not a lot of people in real estate is going to be tracking the US dollar like I do, but when the economy gets stronger, bond yields go up and the US dollar goes up. Look at China right now. China's economy is collapsing. Their 10-year yield is at all-time lows. They have to do whatever they can to stimulate. But here in the US, growth is beating expectations. Retail sales were beating expectations. So bond yields and economic growth goes up. The world economies are not performing well. So the dollar gets stronger. These are two things that President Trump probably does not want to start off his presidency for two reasons. Number one, like we've highlighted for some time now, the wild card for 2025 is because manufacturing jobs were lost in 2024, residential construction workers are kind of next in line if rates stay elevated. We saw the recent builder survey in terms of forward-looking demand that had a fall. Noticeable one, and that tends to lead the builder's behavior. However, we're already working through the backlog, right? We no longer have this big apartment backlog out there, so probably doesn't want to deal with that, right? Because then all of a sudden rates go down for the wrong reasons, unemployment rates picking up, and I don't want to start off the presidency with that. So mortgage rates just getting to 6%. This is the frustrating part, that we're not talking about 3 or 4 or 5, but as a policy, our monetary policy is very restrictive for housing. And the Fed doesn't care about the existing home sales market. It's been fourth year of the lowest home sales ever. But the dual mandate falls a little bit more into the new home sales market. So it's an easy layup, but it's also something that our stance has always been since 2022, labor over inflation. The Fed's not going to pivot, until the labor market breaks or what people want to see, a sub 6% mortgage market. Then, the dollar is getting too strong. And like I've said, I'm going to be the dollar for Halloween. If the dollar goes up to 115 trading wise, it is going to absolutely cause chaos around the world. President Trump wants a lower dollar because if you want to export stuff, having a lower dollar is to your advantage. And just getting a dollar just back to its old trading range would be beneficial for everyone. But the dollar and the 10-year yield were rising up together really since October, and probably not what the president wants to see at this point.
Okay, so he doesn't want to see it, but we talked about this in the summer when he was calling for the Fed to be less independent and for the presidency to have more control over the Fed. What can he actually do to lower interest rates, even just in the United States? Let's not say the world, because of course we would love it if he lowered interest rates. But does he have that lever to pull?
When I see Trump do this, I think of a high school basketball coach working a referee.
Like yourself, I see.
Yes, working a referee, right? Telling the referee, hey, how I used to do it, advantage, disadvantage. That defender is holding my guy. My guy's at a disadvantage because the rules are being broken. To me, if you work the Fed constantly, and then all of a sudden you see residential workers lose their job, as human beings, they will feel more and more pressure that they were behind the curve. So there's nothing really he can do. The Treasury can get involved and try to, cap the 10-year yield, do some stuff, but it's just working a referee. And if things do get bad, make them sweat a little bit. Remember, everyone's human, right? All of a sudden, if you got a whole country looking at you and everyone's saying you're behind and home sales are low and everybody's kind of piling in, and it's not like you're not asking for 3, 4, or 5%, but just getting mortgage rates down 1%. Neil Kashkari will panic. Oh my God, he wouldn't be able to survive. But in this case, working a referee, that's the best he can do in this situation. Now, when he talks about global bond yields, he's telling everyone, lower your rates. Trump has this belief that if he just lowers oil prices, that the whole inflationary story will go away. Now, what lowering oil prices will do is actually make real wages look better, because the core inflation doesn't get impacted by the oil prices, but the headline does, and the headline wages actually look better in that context. The funny part is your real wages tend to look great during a recession because oil prices are falling because demand is falling. Getting global bond yields to come together or lower together. Just remember, after the great financial recession, everyone's rates were really low. We had zero interest rate policy, and rates stayed between 3.25% and 5% for a decade, right? And there wasn't any breakaway inflation, but a lot of that energy prices were tamed. Now, the thing about us in America is that we're already producing so much oil. That's not a thing. And if you thought the builders weren't the March of Dimes, the oil companies
You're like,
are really
I
not
have
the
a
March
group
of
for
Dimes.
you that is not a charitable group.
No, and the best is they don't hide behind it. They'll say, hey, listen, our shareholders won't like this if we lower the price. And oddly enough, when oil prices were getting lower, actually, one of my friends advised the White House that, you really should be buying oil around $67 to $72 a share to try to refill the tank. But also, if oil companies feel like prices are going to be at a certain level, production will keep going, right? So it's kind of like the builders. If the builders thought mortgage rates were at 4.5 to 5.5 for the next 3 years, oh yeah, I can sell the product, So the demand is there, and two different industries, but same kind of concept. So I don't know how you're going to get more oil production out there. I think the oil companies also rejected one of the federal contracts in terms of drilling, just because they're producing a lot of oil. I mean, if you want to see like a glorious chart, look at the oil production chart in the U.S. going back 60, 70 years. We're killing Russia and Saudi Arabia now. We are drill, baby, drill. But that's his belief. If we just lower energy prices, inflation will kind of tame itself, and everyone can lower rates, and then everyone's in a better spot. You don't have to worry about the builders laying off people. If the dollar gets softer, then you could export more stuff. So that's why he's kind of pushing into this area.
The difficulty, of course, is what you said at the top, which was like, our economy is doing really well. Like, it's hard to cut rates when it's outperforming, right?
Well, this is the dilemma. We have such an unfair advantage over other countries, over China, over Japan, over Europe. I mean, look at Europe. Nothing gets created over there. They're old, they're cranky, they have so many regulations. What do they ever build over there? Like, what's their tech? They don't. See, here in America, one thing that we have that other countries, we have like a capital surplus. Like we'll get people funded and get dreams out there and and we have tons of failures, but we just create more stuff in industries and the stuff that other countries can't do. China, of course, steals our stuff. Europe can't create it. Japan's literally simply too old. And India is still not the powerhouse, even though they're massive, massive country with a lot of young people. So being king, it could be a problem with the dollar, and we did this in 2022. For those that don't remember, the dollar was getting toward 112. Oh my, global panic. London was going to lose its pension funds. They couldn't even open the markets there. The Bank of Japan needed to do intervention. The IMF was screaming at the Fed to stop hiking rates. They were going to get Ethan Hunt and then the whole team ready to go after Jerome Powell because, and it just the dollar getting too strong is it's not beneficial for everyone. So we were getting there. The dollar was broken over 110. And we're like, oh, here we go again. And the 10-year yield follows it. So I get it. I mean, I understand why that's the case. You don't want to play with fire, but if you really want to be, kind of exporting a lot of stuff, the dollar being out here is not very useful.
So again, let's talk about tariffs for just a minute. He did mention tariffs in his speech this morning. What's your take?
We'll wait and see what happens.
Okay.
I don't fundamentally. Let me put it to you this way. We have 100% population of human beings in America. 50% of them are workers. 100% of them are net consumers. Even a baby. Baby can't buy yet on Instagram, but the parents need to buy. So one of the reasons why you don't see general trade wars is because it's in a sense a tax, and someone's got to pay it, and it isn't the other country, right? You're trying to prevent, like China has a capacity surplus. If China wanted to, they could just absolutely flood the U.S. car market. And if you want to see a deflationary collapse, they can. They have a capital or a capacity surplus. Here we have a capital surplus in a sense. We have a lot of money out there, but the tactical trade wars, trying to get deals, maybe he just goes, okay, listen, Canada, I'm going to give you 25. You got it. I'm going to squeeze you for a deal. This is just how he operates. And we know this because he did this before. He did a tactical trade war in 2018-19 after getting the corporate tax cuts, when inflation was low, when mortgage rates and all those things were lower. And it still created business investment to go to zero and stocks were down 20%. And that was a better backdrop to do something like that. And that was just a tactical fight. So it's a little bit more complicated than people think. So that's why we try to get people in mind to don't think of a major trade war in that sense. Just think of back and forth tactical, trying to get deals done, and we'll take it from there.
So as you said, the Fed are people. They are looking at this. What level of unemployment job loss gives them cover? Is it still your 323,000 that you've been saying, or now with Trump in, does that change a little bit?
So if jobless claims were heading up toward 320, it doesn't matter what the Fed does. The 10-year yield is going well ahead of them, right? Claims or jobless claims is like the ring from Lord of the Rings. It rules them all. One ring, one data line. If that thing is heading north, doesn't matter what the Fed is. If the Fed wants to sit there and be tight, they're behind. Oh, they've done this before many times. This is not right. We put those charts in there to show you the historical behavior of an institution that always does this. So now, do we expect them to change? I don't know. I just know that data is a little bit more prevalent out there. And then everybody's looking at you and goes, guys, you are the ones who are supposed to track this stuff. And this thing is this going to be another time? So I think the first wave is now that they know manufacturing jobs were lost in 20, if you lose the residential bond yields to go down, the pressure would be so enormous that even Neil Kashkari, who is scared to death of Americans buying homes and having sex at 6% mortgage rates, because how do you balance an economy with 6% mortgage rates? It just can't happen, right? Things will be too good. So I think that's the key data line. That's at least what we've traditionally seen in cycles, is that residential loses their jobs and the Fed goes, it's not a big deal. And all of a sudden, oh God, it's a recession. We didn't see it. So I think that you do the triggers, but you see the residential construction workers lose first because that filters itself to the jobless claims data. Manufacturing and residential, they're impacted by higher rates, capital costs. So that's the thing that we're keeping an eye on. And I mean, that's one of the reasons why the Fed cut 1%. Everyone got to remember the Fed funds rate, the growth rate of inflation. They're restrictive, they believe, because this is here. before somebody spiked the eggnog, and I want names of whoever spiked the Fed's eggnog in December of 2022. The Fed, before the spiking of the eggnog, said, this would be fine. This is kind of what we want. Fed funds rate, growth rate of inflation, 6.3, 12-month PCE, two handles. We bring that thing down to mirror that. But the egg spiking, right? And I wish I was wrong. I wish I was not, the Fed isn't going to pivot into the labor market, but they kind of changed the game back then, and they've held to that belief.
They really have. So bond market could get ahead of you. And I talked earlier this morning because I saw some numbers on some of the actions that that the Trump administration is taking are reducing jobs in one area, right? Maybe they're going to grow in another, but like for instance, the NIH, 300,000 jobs may be at risk because they're not, renewing like studies, scientific studies. I'm not that up on it, but also then we know that he wants to reduce the federal workforce. So at what point do all of those little things, in the larger economy, little things, not little to the people losing their jobs, but at what point does that make a difference?
You know what, if you see the unemployment rate breaks above 4.3%, that's the Fed's trigger, right? They kind of left that down in there. The Machiavellian in me would think, what if Trump just says, listen, let's just fire all the federal workers. Nobody's going to care. And the unemployment rate will go up. We'll force the Fed to cut rates. And majority of the people are still working.
Oh my gosh.
So, I mean, logistically, you couldn't say that. But technically, right, if most of the private sector is still employed and you get your rates lower that way, I better not say that because Elon Musk might think of something like that. I was going to say,
don't give him any ideas.
Yeah, he might go, wait a second, Always remember, there's over 162 million people working. So 300,000 percentage-wise isn't much. But in terms of private payroll growth is slowing down. It can't really afford another sector to be lost. I think that's the bigger story there. And also when housing permits are this low, again, the future supply of production of a supply to fight inflation goes down. So the capacity that you're trying to create, to fight inflation starts to go negative. I don't think they really care about government workers in that sense. So they can be.
No, I agree with you. I don't think they do. I think that's.
Yeah, they can be the chopping blocks for that. But the private sector, right? That's a whole different thing, and that has slowed down. I mean, to be honest with you, the 2024 growth, if you look at it, the healthcare sector and government jobs, that was the big drivers of growth. Healthcare, you could see it. We're elderly demographic population growing, so there's going to be a need for healthcare. Though, you wonder what's going to look like 10 years from now with Ozempic and everything.
It's true,
and how things are going to change in that front. Different conversation that not useful for 2025. But I still believe the Fed purposely kept their unemployment rate target at 4.3% because if something happens, they're going to go, hey, we had this target, it didn't hold. So there are levers to pull. It isn't like what we saw in 2023. Remember, everyone in 2023, the growth rate of inflation fell faster than anybody's models, including the Fed's, and the 10-year yield shot up. And we had 8% mortgage rates and a 5% 10-year. How did that happen? Right? Because the Fed stayed hawkish, spoke hawkishly at that Fed meeting. The economy was outperforming in terms of jobs and GDP, and the 10-year yields, and that would be perfectly normal. But again, we're in the housing industry, so the housing market revolves around the 10-year yield. So it's important in that discussion.
So we will keep an eye on that unemployment rate. We'll keep an eye on jobless claims. I think that's your new catchphrase, is that jobless claims is the ring that rules them all. I think that.
Yeah, I've said that the one labor data line that rules them all. And it's interesting. This week, the BLS created a new rent index, right, for tracking rents real time. That literally had the biggest collapse I've seen, since I've tracked data. Now it's a fairly new index. It's only a year old, but if you look at it, It looks deflationary, not disinflationary. It looks deflationary. So a lot of people came to me like, "Hey, why aren't people like making a big deal about this?" I was like, "Guys, labor over inflation." But realistically, I'm wondering if President Fed Waller knew this data line was coming out, and he came out to the people and said, "Hey, listen, we might get 4 rate cuts this year," because even though they don't, CPI is not their measure that they go off of. 45% of the index is shelter. Let me tell you something: you cannot have core inflation take off if half your index is going noticeably lower. What that index does do is it's got a very short lead time ahead of the CPI shelter. It's been very effective on that. So a lot of people saw that as, okay, core CPI is not going to really take off if this keeps on going. But again, the Fed tracks PCE inflation. That's kind of their ticket. And even though 3, 6, 12-month PCE has got a 2 handle, they still got the Fed funds rate up there.
So labor over inflation, but that did catch your eye. I mean, that sort of
it caught everyone's eye.
eye.
I mean, it's very, very rare to see deflationary rent data. It's just extremely rare. If you look at the history of U.S. economics, where wages grow, we're in inflationary. But that index, I'm assuming it has to get revised higher. That is a utter collapse in the new. I mean, I'm dead serious when I say this. It is one of the most glaring, obvious, like beyond trend from every other data line that I've seen. All the other rent inflation data are steadily rising, like rents do. This one just had a waterfall dive. And it has that short lead time with the CPI shelter index. So I think that's where some people thought it was encouraging, but everyone saw the big dive and said, "Oh my God, what's going on here?" That's in a sense, deflationary stuff is very negative. It's a negative economic thing because that means demand's not keeping up. Something's going wrong to have deflation. Disinflation, inflation goes up and down where the growth rate, but deflation, that's a whole different ballgame. So I'm assuming that gets revised a little bit higher because that was a very, very aggressive move lower.
So we wrote a story yesterday about Zillow finding that single-family homes for rent were 20% higher, priced 20% higher on average than like multifamily apartments because of just the amazing number of multifamily units that have come on board in the last couple of years. I think they said it's the highest now in 50 years. The highest number of multifamily apartments available. And so do you think that is part of it? Is just like the supply is so much that's why we see that disinflation?
So we've talked about this for some time. The apartments are coming on and the units completed are already falling because they're coming and hitting the marketplace. We also have to remember that single family rental households make a lot more money than apartment rent households. So you're dealing with a lot of times a dual household income. So they're a little bit more firmer on the inflation side because they have better household incomes. Apartments, on the other hand, you got a lot of single people. And what we've seen stress in the credit data is a lot of young single people. So you get more supply. Like there's parts of the country where rents are still going down because if you have a lack of migration, I had this discussion with Adam. You interviewed him. He used to be the former economist for Moody's, but he's talking about how are Austin rents still low? Well, if you look at Texas still has migration, but whoa, it's slowed down, right? So if you're building all these apartments and all of a sudden you don't get that migration, so that's a supply is picking up because you're building, but the migration is less. You get that supply and demand equilibrium being more negative. So there's a lot going on in the apartment sector because there's a lot more production, but those things are being finished. Apartment permits are at recessionary levels. So you finish the backlog, and that's why the units completed is really starting to fall down now. You really need permits to keep on growing and growing to keep that data line more progressively heading higher.
We have so much going on. It's a good thing you and I are talking 3 times a week now. And of course, you're writing.
You know what's going to happen, Sarah. The chart daddy is going to be 5 days a week eventually. You're only slowing this train down. You are only slowing this. By the way, I had a lot of fun in Orange County yesterday speaking at an
Yes, you
event.
had an event.
Yeah, it was good. And I would tell you this, half the questions there were about the Palisades fire, as you can imagine. Pacific Palisades, for those who don't know, is a very, very wealthy area. So you got agents, Newport Beach, Corona Del Mar,
Yep.
Laguna Beach, Irvine, San Juan. So people were asking about that. And from what I heard, talking to agents, they're just working nonstop just to get people into shelter, right? For right now, they're not, oh, I got to go buy a house. They're just trying to get their lives together and fix it up. But there are some wealthy people who are already, I'm buying in Newport Beach. Because if you think of Orange County, if you didn't want to stay, I still think a lot of people would probably want to stay around LA. But if you're going to think about Orange County, Newport Beach, Irvine, Laguna Beach, parts of San
They're
Juan
all
Capistrano,
gonna, they're gonna
those
get the
areas are
overload.
as close to what you're going to get to Pacific Palisades, which I grew up in Santa Monica, spent a lot of time in Pacific Palisades, and I live in Irvine. So I'm trying to figure out like what areas somewhat, and those are the only cities I could think of. And they're just getting people in rentals left and right. There's just so much, chaos going in a lot of these people's lives that not a lot of them are just, oh, I got to go buy a house right now. But some of them are really well off. They have the luxury to be able to purchase something in a good area.
It is reshaping the California market, especially the Southern California market. We unfortunately there's another fire this morning, but it's in an area where there's not many homes, which is more what you see with wildfires. This was one of the reasons.
And it does look like rain is coming on the way. So,
oh, good news there. All right, Logan. Well, we will have you on again soon. Thank you so much, and have a great weekend.